How does supply and demand determine a market clearing price? Imagine walking into a busy marketplace where sellers are offering apples and buyers are eager to buy them. The price of apples keeps changing, but how does it settle at a point where everyone is satisfied? That's what we're here to find out. Supply is how much of a product producers are willing to sell at different prices. When prices go up, farmers or sellers want to sell more because they can make more money. Demand is how much consumers want to buy at different prices. When prices fall, more people are willing to buy apples because they are cheaper. These two forces work together, constantly pushing prices up and down. If the price gets too high, sellers want to sell more apples than buyers want to buy. This creates a surplus, meaning apples sit unsold. To fix this, sellers might lower the price to attract more buyers. On the other hand, if the price drops too low, buyers want to buy more apples than sellers want to sell. This causes a shortage, so sellers might raise prices to balance things out. This back and forth keeps happening until the price reaches a point where the amount of apples producers want to sell matches exactly what buyers want to buy. This special price is called the market clearing price or equilibrium price. At this point, there is no excess or shortage. Every apple produced finds a buyer, and every buyer who wants an apple at that price can get one. Now, picture a graph with the price on the vertical line and the quantity of apples on the horizontal line. The supply curve slopes upward because higher prices motivate producers to supply more apples. The demand curve slopes downward because higher prices discourage buyers. The spot where these two lines cross is the market clearing price. In real markets, this process happens all the time. For example, if a new gadget becomes popular, demand increases, and prices will rise until supply catches up. If a natural disaster reduces supply, prices will go up until demand adjusts. This model assumes many buyers and sellers, with all parties having good information. Sometimes, monopolies or government rules can slow down or distort this process. Still, the basic idea remains. Prices tend to move toward the point where supply equals demand. This interaction is fundamental to capitalism because it helps allocate resources efficiently. Prices act like signals, guiding producers on what to make and consumers on what they can afford. When prices are free to change, resources flow to where they are most needed, reducing waste and making sure goods and services match what people want. So, in simple terms, supply and demand work together to find that perfect price where everything balances out. That's how markets keep moving smoothly, helping everyone get what they want at a fair price.